Mike, you talk about a triple contradiction in banking right now. One of them, the contradictions that is, being the present versus the past. Explain to us what you mean by that.
Well, look, banks are treated as if it's 2008 in the middle of the global financial crisis, and today is night and day different for the banks. And so we do see a contradiction. Today, banks have double the amount of equity, over 50% more liquidity. They've gotten out of the most risky activities. They've had oversight by regulators and boards and shareholders for a decade. You've had a stress test for about a decade. Banks are more resilient than they've been in a generation, but they're still treated like it's 2008. And so that's just a mistake that we think the market is making, even while we go through record unemployment. We're seeing bankruptcies, and we're seeing earnings hell for the banks. It's earnings hell for banks. It's going to remain earnings hell for the banks. These are sobering times, but the balance sheets of banks are poised to absorb the problems that are to come.
Yeah, how long does this earnings hell, as you call it, last, Mike? Because it really depends on your outlook on whether you see this recession, lasting a while or being very short, sharp and swift.
Well, certainly the second quarter should be a repeat of the first quarter. You'll see big reserve builds, and that should probably trickle into the third and fourth quarter. So this whole year might wind up being a washout for the banks when it comes to the earnings themselves. So that's when we say that it's an income statement recession for banks. Absolutely. We've reduced our estimates 5 times, and depending how long this lasts, that may be enough. It might not be. We'll have to see about it. But what's interesting, even with all of our estimate reductions for banks, banks, should still have enough earnings to earn their dividend, sometimes by twice as much. They should still have strong capital ratios, and we still have the largest banks growing their book value even with all these earnings problems. That's a big difference versus 2008.